We're entering the last mile of disinflation, and progress is stalling. Are the last 2 months just an aberration, or are we stuck with higher inflation? Hi, I'm Jake Schurmeier, fixed income portfolio manager, with today's episode of the Harvard Lookout. The December CPI print offered further confirmation that the easy part of disinflation is over. Goods prices were flat after 6 consecutive months of declines, and services prices remained stubbornly elevated. The same is true for wages, whether we're looking at the Atlanta Fed's wage tracker or the average hourly earnings data in the monthly employment report. And while 2 months hardly make a trend, growth shows few signs of slowing down. The Atlanta Fed's GDP Now forecast for the fourth quarter implies growth of around 2.4%. Meanwhile, the Dallas Fed's weekly economic index pegs growth at 2.9% as of the first week in January. And the risk of all this is the dovish pivot from the Fed following their December meeting was premature. And if so, we go back to the financial conditions tug of war we saw for much of 2023, wherein expectations for fewer Fed hikes stimulate growth efficiently to necessitate those additional hikes and vice versa. We think the number of cuts priced in by the market is too high, but we think a redux of the interest rate volatility that plagued 2023 is unlikely, as taking rate cuts off the board is a very different conversation than adding additional rate increases and contemplating a much higher terminal rate as we did for much of 2023. Thank you for your time today, and stay tuned for the next episode of the Harvard Lookout.